What if the biggest shift in Bitcoin's entire history is already happening and almost nobody is talking about it? Not the price, not the halving, not some tweet from a billionaire. Something deeper, something structural, something that once it locks in, cannot be reversed. And here's the wild part. The signs are everywhere. On-chain data, institutional balance sheets, government policy, the behavior of long-term holders, even the way your neighbor is starting to ask questions about crypto again. But most people are either too distracted by short-term price noise or they're waiting for permission from someone on TV to believe what the data is already screaming. I've spent weeks going through the numbers, the charts, the regulatory shifts, the macro conditions, and what I found honestly surprised me. Not because it was shocking, but because it was so obvious once you saw it clearly. This isn't a price prediction video. I'm not going to tell you Bitcoin is going to $1 million by Tuesday. What I'm going to do is walk you through 5 undeniable forces that are converging right now, in real time, that are permanently altering what Bitcoin is, who holds it, how it's regulated, and why the version of Bitcoin the world knew in 2017 or even 2021 simply doesn't exist anymore. This is the transition, and whether you're ready or not, it's already underway. So let's break it down, because once you see this, you cannot unsee it.
Point 1. The institutional takeover is not coming. It already happened. Let's go back to 2020 for a second. MicroStrategy buys Bitcoin. Everyone laughs. A software company just put billions into a meme coin, the headline said. The finance world shook their heads. CNBC anchors smirked. Traditional hedge fund managers called it reckless. Fast forward to today. MicroStrategy, now rebranded as Strategy, holds over 500,000 Bitcoin on its balance sheet. That's not a typo. 500,000 Bitcoin. At current prices, that's tens of billions of dollars. And Michael Saylor isn't slowing down. He has turned his entire company into what is essentially a Bitcoin holding vehicle. And Wall Street, the same Wall Street that laughed at him, is now copying his playbook. But here's what's more important than MicroStrategy: the ETFs. When the spot Bitcoin ETFs launched in the United States in January 2024, it was the single most significant structural event in Bitcoin's history. And I don't think people have fully processed what that means yet. BlackRock, Fidelity, Invesco, ARK, Van Eyck, these are not fringe players. These are the firms that manage the retirement savings of hundreds of millions of people. These are the institutions that move markets, not just follow them. And within days of launching, BlackRock's iShares Bitcoin Trust, IBIT, became one of the fastest ETFs in history to reach $10 billion in assets under management. It smashed records that funds had spent years trying to achieve.
Now think about what that actually means. It means Bitcoin is now inside pension funds. It's inside 401k allocations. It's inside the portfolios of insurance companies, sovereign wealth funds, and university endowments. It's sitting right next to S&P 500 index funds and treasury bonds in some of the most conservative financial institutions on the planet. That is not speculative. That is not hype. That is a fundamental restructuring of who owns Bitcoin. And here's the thing about institutional ownership that people miss. It changes the behavior of the asset. When retail traders dominate an asset, it's volatile, emotional, and reactive. Retail sells on fear and buys on greed. Retail follows narratives. But institutions operate differently. They have mandates. They have time horizons measured in years, not hours. They have compliance departments that force them to hold through volatility. They don't panic sell at 3 in the morning when Bitcoin drops 8%. What we're watching in real time is Bitcoin transitioning from a retail-dominated, emotion-driven asset into an institutionally held, structurally supported store of value. That's the transition. That's what changes everything. And it's already happened. We're just living in the early chapters of understanding what it means.
Point 2. The supply shock that nobody is fully prepared for. Let me ask you something. Do you know how many Bitcoin are actually available to buy on exchanges right now? The number is shockingly small. According to on-chain analytics firms like Glassnode and CryptoQuant, the amount of Bitcoin sitting on centralized exchanges has been falling consistently for years. We're talking about multi-year lows in exchange balances. Bitcoin is being withdrawn from exchanges at a pace that suggests holders have absolutely no intention of selling. And when you combine that with the halving, in April 2024, Bitcoin went through its fourth halving. The block reward dropped from 6.25 Bitcoin per block to 3.125 Bitcoin per block. That means miners, who are the primary source of new Bitcoin entering circulation, are now producing roughly 450 Bitcoin per day instead of 900. 450 Bitcoin per day. Meanwhile, BlackRock's ETF alone, at its peak inflow periods, was absorbing more Bitcoin per day than miners were producing. That's not a metaphor. That's the literal supply and demand dynamic playing out in real time. Now layer in something else, the long-term holder data. Glassnode tracks what they call illiquid supply, Bitcoin that hasn't moved in years and shows no signs of moving. This figure has been consistently rising. Over 70% of all Bitcoin in existence has not moved in over a year. A significant portion hasn't moved in 5 years or more.
These aren't people waiting for a better price. These are people who have decided, consciously, philosophically, that Bitcoin is something you don't sell. They've opted out of the traditional financial system in the deepest sense. They're not trading, they're holding, indefinitely. So here's the math, and it's brutal in its simplicity. You have a fixed supply of 21 million Bitcoin. Ever. That's it. Non-negotiable. Coded into the protocol. Nobody can change it. Not governments, not corporations, not even Satoshi himself if he were still around. You have a declining rate of new Bitcoin entering circulation due to the halving. You have an increasing proportion of existing Bitcoin being locked away by long-term holders who aren't selling. You have ETFs absorbing supply at a scale that exceeds daily production. And you have an entire generation of new investors, younger, globally connected, inherently skeptical of traditional finance, who are entering the market for the first time. This is a supply shock unlike anything Bitcoin has ever experienced before. Not just in terms of magnitude, but in terms of the permanence of the buyers absorbing that supply. Retail buyers flip, institutional holders don't. And when you have immovable supply meeting relentless demand, the only variable left is price. You don't need to be a mathematician to understand where that equation leads.
Point 3. The regulatory landscape just tilted, and it's not going back. For years, the biggest argument against Bitcoin adoption was regulatory risk. The government will ban it. The SEC will crush it. Washington will never allow a decentralized monetary system to compete with the dollar. You heard it constantly. And honestly, it wasn't an unreasonable concern. But something happened in 2024 and into 2025 that fundamentally changed the regulatory narrative in the most important market in the world, the United States. First, the ETF approvals. When the SEC, after years of rejections, finally approved spot Bitcoin ETFs, it wasn't just a product approval. It was a signal. It was regulators saying, implicitly, that Bitcoin is here, it's real, and it deserves a regulated framework. That doesn't happen in an environment that's hostile to crypto's existence. Then came the political shift. For the first time in modern political history, Bitcoin became a campaign issue. Multiple presidential candidates in the 2024 election explicitly embraced pro-Bitcoin policies. The idea of a United States strategic Bitcoin reserve, something that would have sounded like science fiction 5 years ago, entered mainstream political discussion. And it didn't stop at campaign rhetoric. Legislative proposals around Bitcoin-specific frameworks, stablecoin regulation, and digital asset classification started gaining serious traction in both the House and the Senate.
Now, I'm not here to make this political. What I'm here to tell you is what it means structurally. When governments go from trying to suppress an asset to competing over who can adopt it most favorably, the game has changed. Other countries are watching.
El Salvador made Bitcoin legal tender. Bhutan quietly mined Bitcoin with hydroelectric power and accumulated a sovereign reserve. Abu Dhabi, Switzerland, and Singapore have been building crypto-friendly regulatory environments for years. The race is no longer, do we allow Bitcoin? The race is becoming, who positions themselves best in a world where Bitcoin is a global reserve asset? That's a completely different conversation. And once a government makes Bitcoin part of its treasury, the political will to destroy it domestically evaporates almost entirely. You don't hold an asset on your balance sheet and then advocate for its annihilation. The regulatory boogeyman that kept institutional investors on the sidelines for years is dissolving. Not perfectly, not uniformly across every country, but the trajectory is unmistakable. And when legal clarity arrives in financial markets, capital flows, fast, predictably, massively. We are watching that process accelerate in real time.
Point 4. The macro environment is becoming Bitcoin's greatest ally. Here's something that doesn't get discussed enough. Bitcoin was born in 2009 in the wreckage of the global financial crisis. Satoshi Nakamoto embedded a message in the very first Bitcoin block, the Genesis block, that read, "The Times, 3rd January 2009, Chancellor on brink of second bailout for banks." That wasn't an accident. That was a manifesto. Bitcoin was created as a direct response to a world where governments could print unlimited money, bail out the institutions that caused financial ruin, and leave ordinary people holding the bag. It was designed for exactly the kind of macro environment that we are living through right now. Think about what's happened to the global monetary system in the last 5 years. Central banks around the world printed money at a scale never seen in peacetime history. The United States Federal Reserve's balance sheet exploded from under $1 trillion before 2008 to nearly $9 trillion at its peak. Money supply expanded so aggressively that inflation, the thing central bankers had declared essentially dead, roared back to 40-year highs. And the response? More debt, more spending. Fiscal deficits in the United States running at over $1 trillion per year during periods of relative economic calm. The national debt crossing $33 trillion, then $34, then $35 trillion and climbing. Here's what that does to the average person's purchasing power. The dollars in your bank account buy less every year. Not because you're spending more, but because more dollars are being created, diluting the value of every dollar that already exists. That's not a conspiracy. That's basic monetary economics. Now, in that environment, what's the most attractive property Bitcoin has? Fixed supply. There will never be more than 21 million Bitcoin. No central bank committee can vote to create more. No Treasury Department can issue additional supply to fund a deficit. No politician can devalue it to make debt payments easier. Bitcoin is the only asset in human history that has a supply schedule written in mathematics and enforced by a decentralized global network of computers that no single entity controls. In a world drowning in fiat currency creation, that scarcity is not just interesting, it becomes essential. And here's where it gets really important for the present moment. The Federal Reserve has begun cutting interest rates. When rates fall, the opportunity cost of holding non-yielding assets like gold or Bitcoin decreases. Money flows out of bonds, out of savings accounts, and into assets that can actually preserve and grow wealth. This has historically been one of the most powerful tailwinds for Bitcoin. We saw it play out after the rate cuts that followed the COVID crash. The pattern is reasserting itself now. Macro conditions, loose monetary policy, currency debasement, geopolitical instability, and loss of faith in traditional financial institutions are not temporary. They are the defining characteristics of the economic era we are living through. Bitcoin was built for this moment, not metaphorically, literally. It was architected for exactly this environment. And more people, every single day, are starting to understand that. Point 5. The cultural shift is permanent, and this one might be the most important. All 4 of the factors I've described, institutional adoption, supply dynamics, regulatory clarity, and macro tailwinds, these are powerful, these are real, these move markets. But there's a fifth factor that I think is more foundational than all of them combined, and it's the hardest to quantify, which is probably why analysts don't talk about it enough. The culture around Bitcoin has permanently changed. Let me explain what I mean. In 2013, buying Bitcoin meant downloading a wallet, navigating command line interfaces, and explaining to everyone you knew why you were buying internet money from strangers on forums. It was deeply fringe. It was associated with dark web markets and tech anarchists, and people who were charitably considered eccentric. In 2017, it became a mainstream speculative bubble. Everyone's uncle was buying altcoins at Thanksgiving dinner. The media covered it like a carnival. Prices went parabolic, crashed spectacularly, and the narrative that emerged was Bitcoin is a Ponzi, Bitcoin is for gamblers, Bitcoin is dead. That narrative repeated itself in different forms through every cycle. But something happened after the 2022 crash, the crash that wiped out Luna, collapsed FTX, sent Sam Bankman-Fried to prison, and destroyed hundreds of billions in speculative value. Bitcoin didn't die. It survived. It kept producing blocks every 10 minutes, exactly as designed, throughout the entire catastrophe. While centralized crypto companies imploded under fraud and mismanagement, the Bitcoin network itself, the decentralized protocol, didn't miss a beat. And that distinction started to matter to people. Not the crypto traders, not the degens, but the serious, long-term, thoughtful investors who had been watching from the sideline, skeptical of the noise and the scams and the volatility. They started to see Bitcoin differently. Because Bitcoin is not FTX. Bitcoin is not Terra Luna. Bitcoin is not a celebrity-endorsed altcoin that goes to zero. Bitcoin is the underlying protocol. It's the base layer. It's the thing that kept working when everything else fell apart. And that realization that Bitcoin is categorically different from the rest of the crypto space has fundamentally changed how serious people think about it.
You're now seeing that reflected in the language used by mainstream financial institutions. JP Morgan publishes Bitcoin research. Goldman Sachs holds Bitcoin-related products. Fidelity offers Bitcoin in retirement accounts. These are not companies that chase trends. These are companies that wait until something is undeniably legitimate before touching it. They've touched it. And culturally, within the generation that will control global wealth over the next 30 years, the Millennials and Gen Z who watched the 2008 financial crisis destroy their parents' savings, who came of age during a pandemic, who live with the daily reality of housing unaffordability and wage stagnation, Bitcoin resonates on a visceral level. This is a generation that inherently distrusts centralized institutions, a generation that grew up with the internet and understands that decentralized networks can outperform centralized systems. A generation that watched governments print trillions of dollars and then scratched their heads when inflation arrived. For this generation, Bitcoin isn't a fringe idea. It's a logical response to a broken system. And they're not going away. They're accumulating wealth. They're entering positions of financial and political influence. And when they arrive fully, and they are arriving, they will bring that Bitcoin native worldview with them. This cultural shift doesn't show up on a price chart. It doesn't have an on-chain metric, but it is the most durable, most permanent, most consequential force driving Bitcoin's long-term trajectory. Because assets don't just need buyers, they need believers. And Bitcoin has never had more of them than it does right now. And the number is growing every single day.
The convergence. Why this moment is different from every other moment. Every Bitcoin cycle has had one or two of these factors present. 2013 had early cultural momentum and tech-native adoption. 2017 had retail FOMO and ICO speculation. 2020 had institutional entry, MicroStrategy, PayPal, Square, and the pandemic-era money-printing narrative. But right now, in this cycle, for the first time in Bitcoin's history, all 5 of these forces are operating simultaneously. Institutional adoption at a scale never seen before. Check. A supply shock from the halving meeting unprecedented ETF demand. Check. Regulatory clarity emerging in the world's most important financial market. Check. A macro environment tailor-made for a scarce, decentralized, apolitical store of value. Check. And a permanent cultural shift in how the generation inheriting global wealth thinks about money, trust, and financial sovereignty. Check. That convergence,
all 5 factors hitting at the same time is what makes this moment different. That's why the title of this video says the change is closer than anyone is admitting. Because when you look at all 5 of these forces together, the conclusion isn't Bitcoin might change. The conclusion is Bitcoin has already changed, and the price and cultural mainstream are still catching up to the structural reality. This is what gets missed in the day-to-day noise of price charts and exchange rate gossip. People watch Bitcoin go up 5% and get excited. They watch it drop 8% and panic. But they're looking at the surface while the tectonic plates underneath are shifting. And when tectonic plates shift, you don't feel it as a smooth, gradual transition. You feel it as an earthquake. Sudden, massive, undeniable. The question isn't whether that earthquake is coming. The question is whether you've thought carefully about where you're standing when it arrives.
The risks, because intellectual honesty matters. I want to be clear about something. None of this is a guarantee. Bitcoin is still volatile. It is still a relatively young asset in the context of financial history. There are real risks. Regulatory crackdowns in key markets could slow adoption. A major protocol vulnerability, however unlikely, could undermine confidence. A prolonged global recession could force institutional liquidations in ways that suppress price for extended periods. Competing technologies could, over long enough time horizons, challenge Bitcoin's dominance. These risks are real, and anyone who tells you otherwise is selling you something. But here's how I think about risk in this context. The question isn't, is Bitcoin risk-free? Nothing is risk-free. The question is, what are the risks of not paying attention to this transition? If you're wrong about Bitcoin and you've allocated a small, responsible portion of your portfolio to it, you lose that allocation. Painful, but survivable. If you're right about Bitcoin and you've ignored everything I've described in this video, the institutional adoption, the supply dynamics, the regulatory shift, the macro environment, the cultural change, you miss what could be one of the most significant wealth creation events in modern financial history. That asymmetry, limited downside with appropriate position sizing, enormous potential upside, is what sophisticated investors call an asymmetric bet. And the data suggests we're sitting on one of the most compelling examples of an asymmetric bet that has existed in any asset class in recent memory. I'm not telling you to bet your life savings on Bitcoin. I'm telling you to take this seriously, to do the research, to understand what is actually happening, not through the filter of media narratives or Twitter hype, but through the lens of data, on-chain metrics, institutional behavior, and macroeconomic fundamentals. Because the moment we're describing in this video isn't theoretical. It's not in the future. It is happening right now in real time. And the window to be ahead of it rather than behind it is not infinite. Closing summary. The moment has already begun. Let me bring it all back together. Bitcoin is changing. Not because of hype, not because of a tweet, not because of some influencer pumping a coin. It's changing because the 5 most powerful forces in finance, institutional capital, supply economics, regulatory frameworks, macroeconomic conditions, and cultural demographics are all pointing in the same direction at the same time. It's changing because the world's largest asset managers are now custodians of Bitcoin, making it part of the fabric of the mainstream financial system. It's changing because the halving has made new supply structurally scarce at precisely the moment demand from institutions has never been higher. It's changing because the regulatory environment in the United States and globally has shifted from hostility to reluctant acceptance to, in some cases, active competition for Bitcoin-friendly positioning. It's changing because the monetary system that Bitcoin was designed to challenge is visibly, measurably, undeniably struggling to maintain the trust of an increasingly skeptical global population. And it's changing because an entire generation, the generation that will define the next 30 years of economic and cultural life, sees Bitcoin not as a speculation, but as a solution. The moment Bitcoin changes forever is not some distant event on a horizon you can barely see. It is the ground beneath your feet, right now, shifting in ways that the daily price chart doesn't capture and the mainstream media doesn't yet know how to explain. The people who will look back on this period as the obvious turning point are not the ones who waited for permission. They're the ones who did the work, understood the structure, managed their risk intelligently,
and positioned themselves before the earthquake rather than after it. This is your moment to decide which group you're in.
If this video gave you a genuinely new way of thinking about what's happening with Bitcoin right now, not just the price, but the actual structural transformation, then do one thing for me. Hit subscribe. Not because I'm asking for a number on a dashboard, but because the conversations we have on this channel are exactly this: data-driven, honest, forward-looking analysis that cuts through the noise. Drop a comment below. Tell me which of the 5 factors we covered today surprised you the most, or which one you think the mainstream is most underestimating. I read every comment, and this community's perspective genuinely shapes what we cover next. Share this video with one person in your life who is still on the fence about Bitcoin, not to convince them of anything, just to give them the information they deserve to have. Because the moment is already here, and the only question left is whether you're paying attention. Stay curious, stay informed, and I'll see you in the next one.